Hello, friends. Welcome to KT Research Guidance Bureau. Myself, Dr. Komodini R. Thakur, would like to say few words for this bureau. This bureau is very helpful to all research students, means those who are interested to do their PhD work. And after PhD, if you want to continue your research studies, this bureau will provide you enough information. Not only this bureau is very useful to postgraduate students who are associated with commerce faculty, means those who are in MCom or MBA degree courses. This bureau aims to provide various topics knowledge and to increase the understanding of the students. Not only this bureau helps you to prepare for NET, SLAT, and other competitive exams. And keep in mind, if you are interested to invest your money in stock market, this bureau gives you complete guideline about your investment so that you can increase your return with minimum risk. So my humble request to you that please subscribe the channel and motivate others. Give your comments for the improvement and do favor for this bureau. I hope at least you will do this. Today's session is specially designed for decision-making theories. In that one, break-even analysis is one of the most important theory for decision-making. Before entering into break-even analysis, I would like to give you brief idea about our entire accountancy. Our accountancy is basically divided into three types. One is financial accounting. As soon as you prepare your balance sheet, your financial account ends. In olden days, there was no computers, no accounting softwares. So that time, financial accounting was the main accounting because it takes too much time for the preparation. But today, various softwares are available. So easily you can prepare your financial reports. Afterwards, our another accountancy comes, that is cost accounting. You learn in SYBCom. It is specially to ascertain the cost and profit. I will also give you this idea but in separate session. And third type is managerial accounting. You are the students of commerce, so you know what is management. You learn everything. And management is for decision making. If their decisions are right, then obviously firm can enjoy better return. Same is the case for our government. Our government is the manager of our economy. If they take proper and in time decision, then they can fight with any of the situation. And I am happy to say that this government management is best management. And no doubt, many persons they criticize the government, but if you see the density of the population and volume of the population, then you have to appreciate the efforts put by our government. So break-even analysis is one of the most important technique to ascertain profit and so many things. So let's begin. What is break-even analysis? I hope you have little idea about break-even because in economics also you learn. This is one of the simple meaning of break-even analysis. Break-even analysis indicates how many units of a product must be sold to cover the fixed and variable cost of a production. So, what it indicates, how many units you have to produce and sell. If you produce and you are unable to sell, then it is useless. Means both you have to keep in mind. Number of units of production as well as sales unit, so that you can cover your fixed as well as variable cost. So far as break even is concerned, we will divide our total cost into two segments. One is fixed cost and another one is variable cost. So obviously, if you want to survive for a longer duration, you have to cover your both costs so that you can run your business for a longer duration. So break-even analysis emphasize on that one. Second thing is, if you want to learn break-even analysis, obviously you have to learn some terminologies for that. So I will give you the brief idea about these terminologies. Among them, first one is fixed cost. As the term indicate, fix means fix. So what you can say for that? A fixed cost is a cost that does not change with an increase or decrease in the amount of goods or services produced or sold. The meaning is very simple and clear. Means if you produce at 10% level of capacity or 50% level of capacity, fixed costs remain fixed. Suppose your electricity bill, it is fixed. If you hired your property, then you have to pay rent. Rent means these are examples of fixed cost. So what is fixed cost? It does not change with an increase or decrease in the amount of goods or services produced or sold. Keep in mind. Another term is variable cost. Vary means change. Varies means variable costs are expenses that vary in production to the volume of goods or services that a business produces. Means if you increase your production, then expenses will increase. If you reduce your production, then your expenses also reduces. Suppose your material, labor. and variable overheads. Suppose you produce 50 units, then the consumption of raw material is only for that. If you produce 100 units, then obviously the consumption is generally double than 50 units. So, if your volume of production increases, variable cost increases. And if you reduce your production, then this sort of expenses also reduces. So keep in mind this meaning of variable cost. If we want to add something in variable cost, we can say the cost increases as the volume of activities increases and decreases as the volume of activities decreases. So these things you have to keep in mind for variable cost, and up to some extent you know. The another most important terminology for our break-even analysis is contribution. So what is contribution? Let's try to understand. The contribution margin is the excess between the selling price of the product and the total variable cost. Keep in mind, only variable cost you have to consider. Means contribution is equal to selling price means S minus variable cost equal to V. So S minus V equal to C. And you have to mug up. What you have to mug up? S means selling price minus V means variable cost is equal to C, your contribution. And generally, in every example, you have to find out contribution. And our BEP is also based on contribution. Now, the another important terminology is margin of safety. Obviously, if you keep safety, then chances of accidents are less. So far as break even is concerned, margin of safety means a difference between actual or budgeted sales and level of break even sales. So suppose your actual sales is 100 and your break even sale is 60. So difference 100 minus 60 is equal to 40 is your margin of safety. So obviously if margin of safety is more, then you are in a good position. Then the another terminology, let's try to understand, that is break-even point. So what break-even analysis tells you? Break-even analysis tells you how many units of a product must be sold to cover the fixed and variable cost of production. Means if you want to cover your total cost, means variable cost plus fixed cost, and for that coverage, how many units you have to sell in the market, and that point is known as break-even point. Now, another one is profit volume ratio. As the name itself indicates, profit volume. The PV ratio in means the profit volume ratio is the measurement of the rate of change of profit due to change in volume of sales. Means if your sales is 1000, then what is the profit volume ratio? If it is higher or less than that one, then vice versa, you have to find out. So obviously, this ratio indicates the relationship between contribution and sales and is usually expressed in percentage. This you have to keep in mind. What it indicates? It indicates the relationship between contribution and sales, and generally we express PV ratio in percentage, and it is very useful ratio for computing profitability as it indicates contribution earned with respect of sales. So in majority of the examples, you have to find out PV ratio. And generally, if you want to find out the amount of contribution per rupee or sales, then you have to find out your PV ratio. So in this one, PV ratio helps you for calculation of your sums. Now, one point comes in your mind, why we have to understand and calculate break-even analysis. So let's try to understand main advantages of break-even analysis. First and foremost is it gives perfect idea about total cost. So many times what happens? If the person has started his business recently or a newcomer businessman, many times he may forget to calculate some of the cost. That time he calculated his profit wrongly. Why? Because he missed to calculate some of the expenses. For them, break-even analysis gives the idea because we divide into two categories, fixed and variable. So he can keep in mind all fixed and all variable expenses. So it is very useful for newcomers also and those who are already in the market. Second thing is, if the person wants to set revenue and sales target, means first of all, many businessmen, they set revenue target. That time, for that much revenue, how many units he has to sell in the market, means at various level of profit, how much sales is required, that he can understand. And another main thing is, a businessman or anybody can plan how much fund he requires, what is the expense of that fund, and after employing that fund in the business, how much profit he will get. So, for planning of funding, break-even analysis is very useful. And obviously, if you want to take better decisions for your business, you have to calculate BEP and you have to find out everything. Another important thing is, Nowadays, none of the businessmen can increase the selling price because various products are already available in the market. So you have only one option, that is cost control and cost reduction. For that, break-even analysis is very useful so that the business fellow or the entrepreneur can survive in the market. And last but not least, this is very useful to fix the selling price. So, if you increase selling price by 10%, then what is the impact of that selling price in your contribution and profit? If you reduce your selling price by 20%, then what will be the effect? That you can calculate very easily. These are some of the benefits. Now, so far as our commerce stream is concerned, we concentrate on examples, and entire break-even point is based on formulas. So let's try to understand the basic formulas and important formulas for the calculation of break-even point. First of all, if you want to find out break-even point in rupees, that time fixed cost divide by PV ratio into 100. I already explained you fixed cost and PV ratio. So this formula keep in mind for your break-even point if you want to find out in rupees. Now, another thing, and in another way, you can also find out break-even point. That time, actual sales minus margin of safety, then you can get your break-even point. So, margin of safety is equal to profit by PV ratio. That you have to keep in mind. Now, if you want to find out your PV ratio, then PV ratio is equal to contribution by sales into 100. This way, you can find out PV ratio. And if there is another type of example, in that example, 2 years profit and 2 years sales are given, then for PV ratio, you have to apply this formula. Which formula? Change in profit by change in sales into 100. And for contribution, you can apply one easy formula. So contribution is equal to sales into PV ratio. Keep in mind. And obviously, you want to take the decisions. So you want to calculate some things for expected profit. So for expected profit, the formula is fixed cost means F plus P means profit by PV ratio. This is for expected profit. For contribution, sales minus variable cost, that I already explained you. So contribution at BEP level, BEP into PV ratio. If you want to find out profit, then contribution minus fixed cost. For profit, sales into PV ratio minus fixed cost, that you have to keep in mind. And for profit, margin of safety into PV ratio. So every day, minimum 5 times read and write these formulas so that you can understand which formula you have to apply in your example. Now, at least I hope that your theoretical background is clear. So let's begin with the example. Today is the first session, so I will give you preliminary examples. Read this example carefully. What is the example? From the following particulars, calculate the break-even point. What is the example? In that one, variable cost per unit is 12 rupees. Your fixed expenses are 60,000 and your selling price per unit is 18 rupees. From this given information, you can find out one another information. So, selling price is 18 rupees. Your variable cost is 12 rupees. So when I explained you that time, I told you that S minus V equal to C. So 18 minus 12 is equal to 6. And your fixed expenses are already given. They are 60,000. So you want to find out break-even point in rupees. So put the formula. What is the formula? Fixed cost by contribution per unit. So how much is your fixed cost? 60,000. And per unit, your contribution is 18 minus 12 is equal to 6. So, obviously, your break-even point is 10,000 units. This is very, very easy to calculate. I hope you followed it. Now, let's switch over to another example. Let's try to understand the example. What is the example? The following information relating to a company is given to you. What is the information? Sales 4 lakhs. Fixed cost 1,80,000. Variable cost 2,50,000. And you have to ascertain how much the value of sales must be increased for the company to break even. So sales is given. Fixed cost is also given. Variable cost is also given. And you have to find out break even sales. And break even sales and your actual sales you have to compare and find out your actual sales is how many rupees less than your break-even sales. So easily you can follow. See, your sales is 4 lakhs and your variable cost is 2,50,000. So obviously S minus V, 4 lakhs minus 2,50,000. So your contribution comes, that is obviously 1,50,000. Now you have formula. Your break-even sales is equal to fixed cost by contribution into 100. Fixed cost is already given in the example. That is 1,80,000. 1,80,000 is your fixed cost that is given. Now you have to find out contribution. You know how to find out. Sales minus variable cost. Your sales is 4 lakhs. Your variable cost is 2 lakh 50,000. So obviously your contribution is 1 lakh 50,000. Put this figure in formula. 1 lakh 80,000 by 1 lakh 50,000 into 4 lakhs is equal to 4 lakh 80,000. What is this 4 lakh 80,000? This is your break-even sales in rupees. Now, your actual sales is already given and that sales is only rupees 4 lakhs. So, apply your common sense. Your break-even sales is 4 lakh 80,000. Actual sales is only 4 lakhs rupees. So, how many rupees sales you have to increase to catch break-even point? So difference between break-even sales 4 lakh 80,000, actual sales 4 lakhs is equal to 80,000. That 80,000 rupees sales you have to increase. Now listen me carefully. In exam, this way you have to reply, and only calculation is not enough. So, as per your example and as per the question, write down your answer. If you consider up to only 4 lakh 80,000, then it is not enough. In exam, clearly mention this way. So, this is one of the easy example. Now let's try to understand with little bit complicated examples. In that one, what is given that you have to find out. Let's check the data. What is in the data? What is given? Fixed cost rupees 8 lakh. Profit earned, fixed cost 8,000. Profit earned 2,000. Your break-even sales is 40,000 and you have to find out your actual sales. Now, again, what you have to do? Break-even sales is given. Break-even sales is given 40,000 rupees. So, you know the formula for break-even sales? Put the formula for break-even sales. What is the formula? Break-even sales is equal to fixed cost by contribution into X. What is given? Break-even sales is given. Break-even sales 40,000. Fixed cost is also given 8,000. And contribution that you can find out equal to 8,000 plus 2,000. And you have to find out actual sales. So we presume that suppose actual sales is equal to X. Now, what comes? The available figure put into formula. Break-even sales 40,000. So 40,000 is equal to 8,000 by 8,000 plus 2,000 into X, or you can say sales. So now arithmetically you can find out actual sales. How many rupees comes? Your actual sales is equal to 50,000 rupees. So check the information and see what is missing. And for that, assume that it is X and then find out the value of X so that you can get your answer very, very easily. Now let's try to understand break even with another type of example. Let's understand the example. A company earned a profit of rupees 30,000 during the year. If the marginal cost and selling price of products are 8 and rupees 10 per unit respectively, what you have to find out? Find out the amount of margin of safety. See, how many rupees you want to earn? 30,000. And your cost is 8 rupees and selling price is 10 rupees. So obviously there is a gap of 2 rupees. Now apply formula. For margin of safety, you know the formula is equal to profit by PV ratio. You know selling price 10 rupees. Then cost is 8 rupees. So your profit is 2 rupees. And you want to find out PV ratio. Then only you can find out. For PV ratio, formula is available. Contribution by sales into 100. You know the contribution. Your contribution per unit is equal to 10 minus 8 equal to 2 by selling price. Selling price is 10 into 100 is equal to your PV ratio. So the value of your PV ratio is 20%. Now, easily you can find out margin of safety because you know the formula. Margin of safety is equal to profit by PV ratio. So your profit is how many rupees? It is already given. That is 30,000. For that 30,000 divide by 20% because you find out your PV ratio and that PV ratio is 20%. So your margin of safety that comes 20% of 30,000 and easily you can calculate that. That comes rupees 1,50,000. So first of all, apply your common sense, find out which formula is suitable and as per that do the calculation. I would like to say one thing that I attach PDF file and for your help you can check it and you can understand with that one very nicely. Now let's try to understand with 2 years data. First, understand the example. Following information is obtained from one company. 3 columns are there: year, units, and result. So far as first year 2018 is concerned, your number of units are 10,000 and that time company suffered a loss of rupees 10,000. Next year your sales increases and it comes 15,000. That time your profit is 40,000 rupees. With this data, you have to calculate fixed cost and break-even sales in units. See, first year it is 10,000 and next year it is 40,000. But first year there is a loss and next year your profit is 40,000 rupees. So what comes in your mind? Only 40,000? No. You covered the loss and after covering the loss, you enjoyed the profit. Means for the first calculation, it is 10 rupees loss and 40,000 rupees profit is equal to 50,000 rupees. So first of all, let's put the formula. What is the formula for this sort of example? PV ratio is equal to change in profit by change in sales into 100. Change of profit, I explain you. First year, there is a loss of 10,000 rupees. And next year, there is a profit of 40,000 rupees. So change in profit, that is 10,000 minus and 40,000 plus is equal to 50,000. And change in sales, first year it is 10,000, next year it is 15,000. So 15,000 minus 10,000 is equal to 5,000. So 50,000 by 5,000 is equal to, you can find out one number, that is per unit your contribution is rupees 10. Now we are the students of commerce, so we know how to find out total contribution, and this can understand even the fifth standard students. Number of units into per unit contribution. So per unit your contribution is 10 rupees and total sales unit for the next year it is given, that is 15,000. So 10,000 into 15,000 is equal to 1,50,000. That is the answer for your total contribution. Now, what you want to find out? You want to find out profit. So, put the formula for that. Profit is equal to contribution minus fixed cost. Your contribution, you already find out. That contribution is 1,50,000 and fixed cost is already given, that is 40,000. So that comes 1,10,000 rupees. Now profit you find out. Now what is the example? In example, you have to find out break-even point in units. So rebrush your formulas memory. And what is the formula? Break-even point in units is equal to fixed cost by contribution per unit. So 1,10,000 divided by contribution per unit, that is 10, is equal to 11,000 units. That is your real answer. I hope you followed the example, because this example was also little bit easy. So this way you find out it. Now, let's try to understand with another example. And my humble request to you that first of all, read the example carefully and try to understand the example. Try to understand the given information, and after that, think which information you can find out. In this example, what you have to calculate? Calculate sales price per unit to bring BP down to 1,20,000 units. So you want to bring down. Calculate margin of safety if profit is rupees 60,000, fixed cost is rupees 6,30,000. Your selling price per unit is rupees 20 and your variable cost is rupees 50. So obviously you can find out S minus V is equal to C. Contribution you can find out. So think twice. What you have to do, you want to find out the solution. For that one, first of all, put the formula. Check the data. In that one, your fixed cost is given. Your variable cost is also given. Your break even is also given. So obviously, you can find out S means selling price. So in units, our formula is F by S minus V. Your break even in example, it is given 1,20,000. So 1,20,000 is equal to your fixed cost is already given. How many rupees? 6,30,000 by C. C is equal to S minus V. But S is not given and V is given. V is equal to 15. So I told you, if you want to find out something, then you can suppose that is equal to X. So what comes? 1,20,000 is equal to 6,30,000 by X minus 15. Now, this is arithmetical calculation, so you can calculate easily. 1,20,000 into X minus 15 is equal to 6,30,000. So, 1,20,000 X minus 18 lakhs is equal to 6,30,000. So, 1,20,000 X is equal to 6,30,000 plus 18 lakhs. So you can find out the value of X. X is equal to sum total of 6,30,000 plus 18 lakhs is equal to 24,30,000 by 1,20,000 is equal to X. You find out that is 20.25, that you find out. Now, you know profit is equal to margin of safety into PV ratio. So, margin of safety is equal to 60,000 is given by 0.25. Now, one question comes in your mind, that is for 0.25. How it comes? Let's try to understand. Your selling price is 20 rupees. So 20 is equal to 100. Then you can find out your variable cost. So your variable cost is 15. So 20 is equal to 100. Then how much for 15 is equal to, your answer is 75. So if your variable cost is 75%, then your PV ratio is equal to 25%, or you can say 0.25. It is one and same. So your answer, net answer comes rupees 2,40,000. This is also little bit easy to understand. Now let's try to understand with another example. See the example. What is in the example? Let's try to understand. Given the following, find the margin of safety in rupees as well as in units. You have to find out margin of safety in rupees as well as in units in both. What is the data? Profit earned rupees 2,40,000. Selling price per unit is equal to 10 rupees. And marginal cost per unit is equal to 7. So obviously 10 minus 7 is equal to 3. That you know. So your contribution is equal to S minus V. That you know. So 10 rupees is your selling price and 7 rupees is variable cost. So 10 minus 7 is equal to 3 rupees. That easily you can calculate. So your contribution comes rupees 3. Now you want to find out margin of safety in units. So for that, the formula is available. P by PV ratio. P stands for profit and 3 that you find out. So 2,40,000 by 3 is equal to 80,000 units. And if you want to find out in rupees, then you have to multiply with your selling price. So 80,000 units into 10 rupees is equal to 8 lakhs rupees is your answer. So if you have to find out in rupees as well as in units, then you can do your example this way. This is also one of the basic example. Now, let's try to understand this break-even point with another example. First of all, we try to understand the example. What is the example? From the following information, if sales are to be increased by 20% of break-even point, then the profit. Fixed cost and present level margin of safety is 20%. Variable cost is 60% and your break-even point is 4 lakhs. This data is already given. So you have to find out that thing. For that, see the available information. And on the basis of available information, find out the missing information. Let's check which information we can find out. In that one, what is given? Margin of safety is given. Your BEPs you can find out. If variable cost is given, then you can find out your contribution. Or C. Let's try to understand. Your margin of safety is already given 20%. If margin of safety is 20%, then your break-even point is obviously 80%. Now, your variable cost is 60%. So 100 minus 60 is equal to 40%. So break-even point in rupees is equal to F by P into 100. Break-even point 4 lakhs is equal to F by your PV ratio is 40% into 100 is equal to 1,60,000. Now, suppose your sales is equal to 100 and your BEP is 80%. So your margin of safety is equal to 20%. Then you have to find out sales. How you can find out? 80% is equal to 4 lakhs. Then how much? 400%. Then your answer will come, and that answer is 5 lakhs. Now, what you have to find out? If sales are to be increased by 20% of break-even point, then you have to find out profit. How can you find out? Let's check. Your break-even is already given. Check the data. That is 4 lakhs. Now, it increased by 20%. So, obviously, 20% of 4 lakhs is equal to 80,000. So, your sales comes 4 lakhs plus 80,000 is equal to 4 lakh 80,000. And you know, profit is equal to contribution minus fixed cost. In previous example, I already explained you how to find out. So 4 lakh 80,000 into 40% minus your fixed cost is equal to 1,60,000. So your answer comes easily, and that is 32,000. So this way you can. Now today I will give you the last example. Let's check it. What is the example? Variable cost 70% of cells. Capacity cells. Fixed cost of the what, and obviously you have to find out BEP. You know the formula for BEP. So put the formula and then proceed. Your break-even point is equal to F by PV ratio. F is equal to 90,000. Your PV ratio 30%. So easily you can find out BEP, and your answer is 90,000 by 30% is equal to 3 lakhs. At which capacity? At 60% capacity. Because in example it is given that you can catch your break-even point at 60% capacity. So at 60% level, that is 3 lakhs. So obviously you can find out at a different level of capacity. So at 75%, how much it is, then you can get the answer. So 60% is equal to 3 lakhs. Then how much for 75%? That is 3 lakh 75,000. Now at 60% and 75% of capacity, you got the answer. You want to find out profit. So profit is equal to C minus F. You want to find out C, that is 30%. 30% of 3,75,000, and your F is already given 90,000. So your answer comes 12,50,000. Now next time I will give you some complicated examples. But do one favor, please subscribe the channel, give your comments and favor the channel and motivate others to subscribe, because for MCOM research and for other competitive exams, this channel will provide you every type of information. Thank you very much. So nice of you. And I hope in future you will join hands with this channel. Thank you very much.